Okay. Well, good morning, everyone. Thank you for joining us at this webinar. Today, we're covering the managing digital assets, the key tax and audit considerations for finance professionals. Just by way of introduction, my name is Pete Osborne. I'm one of the founders and partners of Appold, and I have the pleasure of moderating this panel today. Just for context, Appold is an independent blockchain advisory company. We have clients ranging from institutions, large financial institutions, through to technology protocols in the blockchain area. We also do many other things around that, including acting as auditors experts, which is part of our relationship here. Why are we doing this? Well, really, we've had overwhelming demand to hold a webinar, and really in an environment that's transforming quickly. The use of digital assets is rising rapidly, and this has really put pressure on firms to respond, mainly around finance and risk and tax. And this has fueled changing regulations. And in a very fast-moving market, we just want to be ahead of all these changes. Blockchain itself is harmonizing in with traditional finance, and we see that speeding up over the next few years. But really, we want to just look at some of the impacts for companies and individuals. So what I'll do, if we could just make a quick introduction, and we'll go from there. Tom, I'm going to ask you just to make a quick intro and maybe just say a few words about Gravita as well first.
Thanks, Pete. So, Tom Adcock, tax partner here at Gravita. Gravita is a audit, accounts and tax advisory firm, which has offices in London, the Southwest, the rest of Bristol, up in Oxford, and we have an office in Ilford and Essex as well. We support and advise clients from all over the world, both just their compliance needs as well as their advisory requirements. Helping, my world is helping them navigate the UK tax environment. But we also help and support our clients all over the world because we have friends all over the world that can help them in other jurisdictions. So that is what we do and how we do it. We're a team of 600 people. And you won't probably have heard of us because we are fairly new to market. Gravita itself is a consolidator, which is happening all over the marketplace, and it's pulled together a number of the good-sized firms to come together with similar values, similar cultures, and to help and support our growing client base. That's what we are.
Thank you. And Rob?
Hi, my name is Rob Gaskell. I'm the co-founder with Pete of Appold, a blockchain advisory company.
Dan?
Hi, my name is Dan Howarth. I'm an audit partner here at Gravita with a kind of interest, specialism in the crypto space. We started our crypto auditing journey really back in 2017 and we're collaborating with one of the leading US firms in the crypto space. And we've kind of built up our client base, our specialisms and expertise from really that day until now. We're doing some fairly large, complex audits in this space.
And just for context on that, Appold and Gravita have had shared clients over the past 3 years across different assignments. And about a year and a bit ago, we announced a partnership around financial audits where Appold's working as the auditors experts and Dan and his team are going through the financial side of that. But enough of me. Let's get on to the questions. And I think just to start with, to Rob, why would an organization use digital assets? And what are the patterns that you're seeing in the sector in that context?
Sure. So typically some of the more complex audits that we assist with are on companies that actually provide services around digital assets. So exchanges, custodians, futures platforms, and brokers and so on. They're actually handling the digital assets themselves, but they're providing services to companies that might want to buy or individuals that might want to buy digital assets. And why would you hold digital assets? Well, typically the most prominent digital asset is Bitcoin. Bitcoin is seen as a store of value as well as a currency hedge to a lot of institutions that might want to buy and hold it. There is also another type of digital asset is a stable coin, which is used for moving money around, but backed by US dollars typically is the most prominent stable coin. and many companies are using that for moving money, or individuals are using it for remittance, moving money around the world in an easier way than you can do through traditional banking rails and payment rails. But why would a company be interested in this area? New companies coming into the space and actually starting to look at these as a different form of finance, a different asset class, and when they get comfortable with that asset class, they're actually buying that asset. But then they have the issues around how they store it, and then also how do they account for it. And then this is where, with this growing market, where regulatory clarity is starting to come forward, specifically with the drive in the US market, with the change of attitude on these digital assets themselves. We are starting to see more companies get into this and certainly start to investigate, if not buy these assets. And if you buy them, then you need to record them, and you need to know what to do with them from a tax point of view and also a governance point of view.
I mean, just on that note, Dan, I mean, in regards to financial statements, what is the classification of digital assets?
Thank you, Pete. It's a good question, and the question that I'm asked quite often. And like a lot of the answers to something in this space, it depends. So the UK standard setters have been behind on this for a number of years. They released some guidance in 2018, which was updated in 2022, finally, which gave some guidance as to the classification of crypto assets. And I mean, the guidance really says it depends on what you're doing with it. So is it cash? The answer to that really is no. The definition of cash is it can't be highly volatile, which back in 2018, when this was first released, a lot of the cryptocurrency was so volatile that it kind of cancelled that out. And it's also not legal tender. Inventory, is it stock? Potentially, it could be stock, depending on what the corporates do. If it's a corporate trading institution who's trading crypto, then it's quite feasible to classify it as stock. Where most people are landing with it, I mean, and to just say back up on Rob's point, where people are holding it as a store of value, people were now saying, are we holding Bitcoin as an investment? And if that is really what the institution is holding it for, if they're just going to want to hold Bitcoin and see the value grow, then it can be an investment if that is what the company's plans to do with it. Where most people have landed with it, though, is it's probably an intangible asset. Most of the UK companies with crypto in it is where we land. It's an intangible asset. It fits the definitions to an intangible fairly well. It's separable, it's measurable. It can be sold, and you can see value from it. And it also gives you the flexibility, if it's an intangible asset, to revalue it. So you've got two options. You can have it at cost without impairment. So if it goes down, you take the downside. But lots of people want to realise the value that they've got in their financials. So an intangible with a revaluation model is where most people land.
Cool, great, thanks. And I think, Tom, just kind of in tune with that, I mean, can timing be an issue when dealing with these assets, and when should income actually be recognised?
That's fair. That is an excellent question. Okay. Yes, is the answer. Next question. No, so it is really important. Timing for crypto assets is, crypto assets are not, they're not just one thing. They generate multiple types of return. So you get a return in capital appreciation, and you get a return sometimes from what you would otherwise call stock lending, but you stake it so that you can get return on that. And that is often where you see the problem rise. It's fairly easy to ascertain a time where you converted one crypto asset into something else. So you've got a sale. You never forget that just because you haven't taken it out of your wallet The fact that you've gone from Bitcoin into Ethereum or some other crypto asset, that is a transaction that needs to be recorded. So that can trigger an event which can be taxable if it's made a gain and renewable if it's made a loss. So that's one part of the timing. But where we see more issues is that it's where you have staked your crypto asset and you're generating a return on that. And that return, from a tax perspective, needs to be under the accruals basis. And the accruals basis basically says, well, when did it actually arise, not when you can call upon it and use it. And we typically see that being a problem, and it can mount up quite quickly. So yeah, the timing is quite important, but it can also be helpful because you can try and use that to your advantage, particularly when tax rates are changing up and down.
Cool. Oh, thank you. I mean, Dan, blockchain is complicated and relatively new. Many auditors have exited this market. It's very well documented. Many are shying away from this market. How are you approaching this, and how are you using specialists in audits for audit management?
Thanks, but yeah, it's a great point. There is a lot of accountants, auditors who will just have a blanket no policy to crypto, or have done in the past. I think in the US we're seeing that is changing. So all of the big players are coming back into the market because I think they're realizing they just can't stay away from it because it's here to stay, so to speak. The UK is behind in terms of where the US are. And I think the issues that most auditors, accountants have goes back to my first point in terms of there is a lot of judgment around it. Accountants don't like judgment. And you even have to decide how to classify it in the first instance. There's issues around valuation. And I think the accounting audit profession, the lack of guidance that's been out there, scares people. As accountants like following rules and standards and audit standards, and the lack of, I think, makes people jumpy around it. And also, this is coupled with a big, massive UK shortage in the audit market. So it was very simple for audit firms to say, we'd be risking our portfolios. Let's just say no to crypto. And that happens quite a lot. There was a huge top 6 firm that came out of the crypto market, top 10 firm across globally, which is quite well documented.
Yeah.
So, I mean, how do we approach that? I think it's really getting our understanding right at the start of the engagement, really, and really getting to know your client. And this is where these guys come in. Appold can come in and really evaluate what is there, what is the entity actually do. That's quite important. What are the risks involved in terms of for the entity, which then imputes to the auditor, and really it's just having that expertise to kind of really engage with the client at a very technical level sometimes, you can talk really technical stuff around the IT controls and safeguarding, and there's some quite very complex IT things that a normal audit engagement wouldn't see.
Yeah.
So,
Maybe Rob, you can expand on that a little bit because you oversee the auditor's expert team.
Mm-hmm.
What just from what Dan said, if you could drill that a little bit more, what are the areas of focus?
Sure. So when we're engaged by financial auditors, typically we work alongside them to look at the technical side of a company that's either issuing or supporting digital assets in some way. So with Gravita, we've worked on, as I said, a crypto exchange. So a big global crypto exchange with the custody side of that business, and also they have a futures platform as well. Different entities, so we will be involved in different entities within the group. So they have complex company and corporate structures, as well as complex technical environments, as Dan said. And the complex technical environments are they build up custody solutions and custody of these assets, is a very difficult thing to do, I would say, in a very safe way. You have got all kinds of issues of key person risks. You have issues of the way that things are built from a technical point of view, the way that the solutions are safeguarded, and that there are significant security ring fences around custody, which are very complex to understand. So we look at it from a risk point of view, from a technical point of view, from a human. The internal risk and the external risk is assessed. And then we also look at, if it's a crypto exchange that's got trading side of the business, then obviously we want to understand how they're making their money, the revenue that supports the company. And we trace that all the way through using their technical platforms and compare that to the actual blockchain records itself. But again, very complex analysis. And we support financial auditors with that because, the knowledge of what Appold's built up over many, many years gives us that ability to really understand and interpret and then explain this so that the auditors get the best out of the audit, and also the clients they have get the best from the audit.
Okay, just stepping away from audit a little bit and just going back to a point you made about intangibles. I mean, one for you, Tom. Digital assets, security or intangible, and why? And who is saying it?
It's an argument, and we're not helped by UK regulators because they are not yet ready to say one way or the other. I think those of us that are involved in the crypto space are hopeful that the US will solve this problem, and that the legislation which is passing through US Congress will give us that answer. It's not part of the big beautiful bill, so it is separate to that, and therefore may fly under the radar, and we may get what we want without it being a political hot potato. Tax, to a large extent, cares and doesn't, right? So from a tax perspective, what the government tries to do is it tries to put crypto into a box it already understands, right? So it says, okay, what type of asset is it? And at the moment, it equates it more to security than it does to anything else. So the marketplace backs that up, because you can do very similar things with crypto assets that you can do with stocks and shares. And therefore, that's how we tax it. The main difference is to do with the status of the asset, and the fact that anything that's thrown off from staking, for example, of a crypto asset is treated ordinarily as income and regular income, as opposed to being dividends, which you'd otherwise get on shares, which has a different tax consequence, because dividends are not always taxable, or usually taxable in the hands of companies. So CITES is important. CITES is important for a number of reasons, because it leads to where the thing is taxable. In an individual's hands, which you can't forget with these things, is the CITES of a crypto asset is where you are, which is quite important. So if you're in the UK, then it's taxable here, and that's taxable to inheritance tax as much as it is taxable on everything else. If you're not here, then it is not here, and therefore you are not taxable primarily to capital gains tax and or inheritance tax, which is the big one. Dubai is full of people now who are British, you have to have quite a lot of crypto assets. So that's that. With companies, it leads you down a route of, where should I hold it? Because the asset is where the person who holds it is resident. And the UK taxes it, and the UK corporation tax rate is 25%. So that's quite a big number. The corporation tax rate in other jurisdictions, well, let's take, for example, the Cayman Islands, is a fact total of 0. And that, although I can't give advice on Cayman taxes, is quite a good place to hold cryptocurrency. So what we are seeing is businesses that are maturing, is they are moving their crypto assets out of the UK tax net and into a tax net which is more favorable to them. As it happens, some of those jurisdictions are actually more, they have better legislation or better environments that can sort of operate and look after those types of assets. Now, doing that triggers its own UK tax consequences. Unsurprisingly, you can't move assets outside of the UK tax net if you're a company without having to pay tax on them. So the UK operates a corporate exit tax, so that if I take my crypto asset with a gain of say £1 million, and I move it from UK to, let's take the Cayman Islands as an example, I'm going to pay £250,000 worth of corporation tax. Now, the £1 million is the question, and this is where Appold comes in, because the valuation of those crypto assets when you shift them is really important. And there are loads of rules about how you value assets, and there's loads of rules about how HMRC approach it. But you can, because we have experience and successful experience at that, in agreeing with HMRC, not so much the value, but the methodology that underpins the valuation that you are coming up with. So you can take that £1 million then and try and reduce it. And for individuals, there is some good news because we don't have an exit tax for individuals. I'm not sure that it's going to survive all that long, much longer. So,
Does similar apply for cross-border payments using digital assets? Because this is more like transferring.
Transferring assets. You're right. I mean, look, using crypto assets to make payments is a different issue. So from a tax perspective, it's equivalent to like using cash, right? Now, if the crypto asset leaves the UK entity and goes to another entity and it has gone up in value, then it's a disposal of the underlying asset. It's a bit like using like real estate to pay something, right? There's no difference to that.
So it's a crystallization effect.
Crystallization,
tax on
absolutely
that,
right.
Transfer.
And don't forget VAT in those circumstances. Just because you're not using cash doesn't mean it's not back to me.
Perfect. I mean, the governing body for audits and accounting, the ICAEW, I mean, what are the guidelines now around audits in particular? Is it evolving a lot or slowly? How are you finding it?
Yes, so the ICAEW were silent on this for a long time. They released a very useful document in 2024, which really set out what auditors should be considering if they're thinking about insurance market. I'm not sure if when people read it, they thought it's definitely not for us because there is a lot in there. But I think for those that are involved in this, it was incredibly useful. And I think the ethos of the document really is around two main areas. I would say is risk assessment and understanding the entity, which is again where we use you guys, and the control environment, which is really important, which is a specialist area. And I think it really pushes, if you read the document carefully, it's really pushing to say, do you really have the expertise in-house or can you lean on this expertise really to audit these companies effectively? But it's a very, very good document. It's detailed and it tells you exactly where or what you should be doing. We were very pleased, I think, when it came out, because I think it's as a team, and with Appold, I include them as our team. We are doing all of the things that the ICAEW are saying will need to be considered, especially around it mentions a lot about the specific risks around onboarding, valuation, all of the kind of judgment areas that we've leaned on. And we've managed to kind of go through the document and say, this is how we're tackling these parts, whether it be us in-house, with Appold, or as a team, really. So I think it's a very welcome document for people that have the expertise, whether it will attract some people to have a dabble in the market from the audit profession, I'm not sure. But certainly it's welcome and it's moving in the right direction.
I think another point as well is that it supports your clients in understanding what they need to do as well.
Yeah.
Sometimes it's quite hard to explain to clients what you have to do in terms of the full audit scope.
Yeah.
And with the support of the audit regulators, you're able to explain that in a clearer way, I think.
Yeah, that's a very good point. Yeah, because I mean, a lot of these companies are still in their, as we've said, so the control environment, the systems of controls are sometimes challenging compared to a kind of institution that we've kind of dealt with.
It's been around for decades,
Decades.
hundreds of years sometimes, and they've had all the experience to do that, put that in place.
Okay, well, we actually have a number of questions coming through. I think I might just do one more question to you, Rob, just to wrap up this part of it. I mean, what are some of the pitfalls and the risks of dealing with these assets as opposed to traditional finance assets? In short,
Yeah, sure.
there's a lot to say about that.
Yeah, I mean, well, traditional assets, whether that be putting property or stocks onto your balance sheet, or you've got cash, you've got fiat currency from different countries, maybe on your balance sheet for international operation. That's a very traditional way of storing. You're partnering with banks, you're partnering with custodians for your stocks, you're partnering with maybe property companies for the property portfolio. It's very much a partnership type approach. Now, you can go down that route as well in the digital asset space and have partners for your trading, for your custody. But some of the exchanges, they do a lot of it themselves. So then it's just handling everything in-house. So I'll say one of the big differences is that certainly trading environments try to do everything in-house. I don't trust a lot of the other businesses in the space, whereas traditional, they are absolutely trusting the market. And a lot of that has to do with regulation. But if you're in the financial services space in a traditional banking institution, you're fully regulated, you're dealing with regulated partners that you can trust. They're operating in a correct way. They have all the governance in place, system and controls in place that have been built up over many years. In the digital asset industry, it's still, the whole word we've been using for many years is still nascent. There is still a lot of things that need to be done and learnings that have to come across before you would say that it's a fully regulated space and you can trust all of the companies in the space and operate with them the same way that you can in the traditional sense in the older world.
Yes. Okay, let's just look at some of the questions. Just quick fire, really. What's the panel's view on how the FCA policy will affect the industry, and what could be the impacts of that?
Well, the biggest impact is regulatory clarity. As we've said, with a bit of lack of clarity we have now, things are a bit confusing for the market. And, and it also prevents people from operating in the space. Traditional companies that are looking at this space without clear regulation and clear understanding find it very hard to navigate, I would say.
I completely agree. I mean, certainty is a very useful thing. You want flexibility and you want option.
Sure.
But certainty about how assets are going to be treated, it helps everyone to navigate the space, not just the clients, but also the advisors, because they can say, this is the thing, this is how it works. I think that would be very helpful. Enormously helpful, and I hope it happens soon.
There's always a Trump question, right? Will Trump's impact on US crypto policy affect the UK?
Yes.
Yeah.
You can go wrong. The Americans, we've said many times already, they are so far ahead on this particular asset class. And it's not surprising because they picked it up earlier than everyone else did, and they've driven the marketplace. So the US, I think everyone's waiting for the US to determine certain things. And once they have done that, then I can't imagine that the UK will deviate from there, neither the EU and neither anyone else, because put another way, they're doing all the heavy lifting, so we don't have to. And I think that's what's happened.
I mean, there has been some announcement, there's cooperation between the regulators and the changing regulation in the US and the FCA here and the regulator in the UK. There has been some collaboration around these topics, and there will be some synergies that are generated from that. But we mustn't forget that the European have been quite ahead in terms of putting regulation in. MiCA's gone live, which is the digital assets regulation for European entities. It's still quite complex because it's still issues are being ironed out between the different countries within European Union, and they have some slight differences there, which make it quite confusing again in the market. But generally, regulation is moving on, and the UK has been, I would say, a little bit behind on this, but absolutely the US and what they do, I think, will influence the UK and make sure that this is given the priority that it deserves.
Okay, but Probably one for you, Tom. How are family offices beginning to factor digital assets into long-term inheritance planning? And are bespoke structures like crypto-specific trusts or offshore foundations gaining traction?
As an answer to the question, as crypto assets are becoming more commonplace and well understood, and to some extent the volatility in the marketplace is dampening, everyone's recognizing that maybe share portfolios are also quite volatile to announcements from the White House, for example. The value has been placed into crypto assets. And as I said earlier, crypto assets, the status of a crypto asset is where the person is that owns it. Now, for tax purposes, that person can be an individual, can be a company, could be a trust, can be an ANSTOC, can be a foundation, can be any other public vehicle you can think of. And you have freedom to establish these structures pretty much anywhere in the world. So you, ignoring loads of anti-avoidance legislation, you could establish a structure, a foundation, in Liechtenstein, which could hold the asset. Now that may be very beneficial from a tax perspective. What you then need to pay attention to is all the anti-avoidance legislation, which says, where is that asset really? Where is the entity that owns that asset really? And go through that process. But it is driving, in the same way that it drove people, particularly wealthy individuals, wealthy families, to establish offshore trusts and offshore companies to own UK real estate, because the tax environment was such that it made that a very attractive option. It is doing the same thing to us. It's just driving that same change. And the fiduciaries, because you need to engage them in these overseas jurisdictions, are more comfortable with this asset class than many perhaps think they might be, because they're involved in it from day one. So it can be it's sometimes easier to find a fiduciary to look after your crypto asset business than it is an auditor. But now you guys know us, then it's easier to find one as well.
Yeah, no, fair point. I think I'll just take two more questions. In fact, just on the auditor point, someone's here that has actually said they found it very hard to find an auditor that will take on this kind of business. I think the partners want to, but the risk committees tend to knock it back. I mean, you tapped on this a little bit earlier, but from your perspective, obviously that's a good thing. But why has it been so challenging, I guess, to get risk to approve audit teams on this?
That's an excellent question, and one that I faced internally myself quite a few times. And I think it really goes back to, again, I mean, we've said this so many times in the last half an hour or so, is understanding the entity and what they're doing. I mean, I had one example where, I mean, if you don't know the space, there's a kind of a thought to say, it's so volatile, it's risky. Are we going to get paid? Some things that partners say. It's like, these guys are typically holding all of their value in crypto. You really need to understand what they're doing and how they're using it and what they're doing it for. And I mean, it also depends on the entity. Is it something that is looking risky and is very infantile, and they're asking you to do? What are they asking you to do? Just any other company in terms of risk, but really understanding where the source of wealth has come from. Who's behind the operations? Is there a deep understanding within the entity itself, which is a struggle that we've had. We're facing a case at the moment, a forensic case that, it's really understanding what is going on from transaction to execution throughout the whole process. But if you can get that understanding up front, and then it's about demonstrating to the risk committee internally that we've got the resources to do this, which is where, speaking openly and communicating with people and saying, right, how are we going to do this? What's your playbook from day one, really? I think that's the key.
Okay, I think one last question, we'll wrap up. This may have a binary response, yes or no to it. Do you think digital asset adoption will grow, or is it a fad?
Probably. I think it's borne out by, it's easy to understand that there is an increasing demand for this area, and it's going to grow because what we talked about earlier, regulated regulatory clarity, and that's being worked on in jurisdictions all around the world, will bring more and more people into this asset class, into this world of blockchain, as well as the digital assets themselves. So 100% is growing.
I think we've seen it crash and think, it's going to go away a few times. And there's been some quite high level collapses across the world which haven't helped, and some, let's not shy away from it, some ICOs which have been completely fraudulent. But I think, it all goes back to the regulation and the clarity of is there rules and regulations behind it, and is there customer confidence in the assets to say that, that this is something that is really here to stay. It's not going anywhere.
Yeah, I think it'll change. I think it will grow, but I think it will change quite significantly. The idea that you've got thousands of tokens that are tradable on the market, I think will change. I think that will diminish significantly over time, and it will mature. Whether it ever goes the full hog and replaces or becomes a serious competitor to the use of cash or fiat in order to carry out transactions, particularly small transactions, I'm not 100% convinced. But for global movement of high value, it's difficult to see how it could ever not exist anymore. Do you know what I mean? It's like it's become so synonymous with those kind of transactions, particularly that, and blockchain technology is a welcome asset to use in it, and hopefully that permeates all business because it doesn't have no life easy.
Well, we could run a whole webinar, a whole conference on that. I think we'll wrap up there. Tom. Thank you. Appreciate it. Thank you for joining us today. If you've got any questions or anything like that, please reach out to us. The contact details are there. So thank you for joining us.
Thank you.
Thank you.